Book 2, Chapter 5. Of the different employments of capitals. Capital can be employed in agriculture, manufacturing, wholesale trade, or retail trade. Each use is necessary, but they do not support the same amount of domestic labor or add equally to national output. Smith evaluates them by how directly they maintain productive workers at home and how often the capital returns to its owner. Agricultural capital employs labor in cultivation and draws productive powers from nature. The farmer's advances return with both the laborer's work and the natural growth of plants and animals. Smith therefore treats agriculture as especially productive, while rejecting the physiocratic claim that it is the only productive activity. Manufacturing capital maintains workers who transform materials. It reproduces wages and profit in the value of finished goods. Retail capital divides goods into convenient quantities and brings them to consumers. It is useful. But if too many retailers compete for the same trade, capital is fragmented without proportionally increasing output. Wholesale capital takes several forms. The home trade buys domestic produce in one part of the country and sells it in another, keeping both ends of the transaction within the national economy. Foreign trade of consumption exchanges domestic goods for foreign goods consumed at home. Carrying trade transports goods between foreign countries. For an equal capital, the home trade generally returns more frequently and maintains more domestic labor because both the purchase and sale concern home production. Foreign trade supports domestic industry at one end, but the return may take longer and part of the capital maintains foreign labor. Carrying trade can be profitable to merchants and useful when a country has surplus shipping and capital, but it contributes least directly to domestic production. These rankings do not justify forcing capital into a particular employment. Individuals seek the safest and most profitable use available, and their choices reflect local knowledge. A country naturally develops the home trade first, then foreign trade, and only after capital becomes abundant does it enter carrying trade on a large scale. Policies that force this sequence or privilege one branch can misallocate capital. The general principle is that the annual produce grows when capital circulates quickly, employs domestic productive labor, and is placed where it can earn an ordinary return without monopoly. The private pursuit of security and profit often directs capital toward uses that also support national industry, although Smith never assumes that every merchant proposal serves the public. The accounting of money can be made more precise. The value of the annual product is circulated by money, but the same coin performs many purchases in succession. It is therefore unnecessary to hold a quantity of coin equal to annual income. The required stock depends on the frequency of payments, the organization of credit, and the denominations used. Improvements in clearing and banking allow a larger volume of commerce to be carried by a smaller metallic base. Smith compares the substitution of paper for metal to replacing a costly road through the air with a cheaper one on the ground. The saving releases land and labor for other purposes, but the new path must remain secure. If the banking system collapses, transactions are interrupted precisely because the economy has come to rely on the paper instrument. This is why the gains from economy must be balanced by rules that preserve redemption. A bank can safely advance only a portion of the capital employed by a merchant. The merchant's own fixed capital and long-term needs must be funded from resources that do not require rapid repayment. When a bank repeatedly renews loans that should have been repaid from sales, it loses the ability to distinguish a temporary commercial advance from a permanent investment. The customer appears solvent only because the bank continues to provide the means of payment. Competition among banks can improve service and restrict monopoly, but it does not eliminate all risk. Rival institutions may imitate aggressive practices to avoid losing customers. The discipline of note redemption, the liability of owners, and careful observation of borrowers remain essential. Smith's praise of Scottish banking rests on institutions that combined competition with frequent settlement and personal guarantees. The release of gold and silver after paper substitution is not instantaneous national profit. Bullion exported for machinery or materials can expand future output. Bullion exported for wine, ornaments, and other consumption goods is consumed. Both exchanges may be voluntarily beneficial, but only the first adds to productive capital. The distinction mirrors Smith's broader argument that expenditure must be judged by whether it maintains productive labor. His definition of productive labor is tied to the economic structure of the 18th century, but the analytical point is about reproduction. Labor is productive when its value reappears, in an asset or commodity that can replace the advance and yield profit. A service can be important, skilled, and well paid while still being financed from current revenue. The classification does not determine moral worth. Smith also notes that the same person can perform both kinds of labor. A worker repairing a machine used in production adds to productive capacity, while the same worker repairing a private ornament serves consumption. What matters is the relation of the work to capital and future output, not the social rank of the worker. Accumulation raises demand for productive labor, and growing demand raises wages. It also expands the division of labor and encourages machinery. Saving, therefore, affects output through more than the simple number of workers employed. It changes organization and productivity. Conversely, the destruction of capital reduces both employment and the capacity to produce efficiently. The hierarchy of capital employments in Chapter 5 depends on turnover as well as location. A capital that returns several times in a year can support repeated rounds of wages and purchases. A distant trade that returns only after a long voyage ties up the same stock for longer. Insurance, freight, and uncertainty also absorb part of the return. The preference for nearby employment is therefore grounded in both security and velocity. Smith does not claim that every country should avoid foreign commerce until all land is improved. Trade can open markets and supply useful inputs. His argument is that a country gains most when foreign trade supports the employment of domestic capital, rather than being treated as an end in itself. The volume of exports is not a sufficient measure. One must ask how much domestic labor and annual produce the trade maintains. Book 3, Chapter 1, of the Natural Progress of Opulence. Smith describes a natural order of development. People first direct capital toward agriculture, because food is necessary, land is visible, and rural investment is relatively secure. Once agriculture produces a surplus, capital moves into manufactures that serve the local market. Foreign commerce grows later, when domestic production exceeds domestic demand and merchants exchange the surplus abroad. This order also reflects preference. When profits are equal, many people prefer improving land to engaging in distant trade because they can observe and control the investment. Agriculture anchors capital to the country and provides employment near home. Europe did not follow this natural sequence. After the Roman Empire, institutions discouraged cultivation and allowed towns and foreign commerce to advance before the countryside had been fully improved. Book 3, Chapter 2, of the discouragement of agriculture in the ancient state of Europe after the fall of the Roman Empire. The Germanic conquests divided land among military leaders and established great estates. Primogeniture and entails preserved these estates intact by preventing division and sale. Such rules were understandable in a violent age, when large properties supported military power, but they outlived the conditions that created them. Land remained concentrated in the hands of owners who often lacked either the capital or the incentive to improve it. Great proprietors governed their domains like minor princes. Much land was cultivated by slaves or by dependent tenants whose insecure position discouraged investment. A slave has little reason to improve production beyond what is compelled, because the master receives the gain. A tenant at will cannot safely spend capital on drainage, buildings, or soil improvement if the landlord can remove him or raise the rent after the work is complete. Gradual changes in tenure improved incentives. Serfs were replaced by métayers who shared output with landlords, and later by farmers paying fixed rents. Long leases gave tenants time to recover investments. In England, legal security and respect for the yeomanry encouraged improvement more than in many parts of Europe. Even so, tithes, primogeniture, entails, and restrictions on land transfer continued to impede cultivation. Taxation could reinforce the problem. Arbitrary taxes and uncertain obligations made improvements dangerous because visible prosperity attracted additional demands. The natural progress of agriculture requires security of property, predictable law, and the possibility of retaining the fruits of investment. Without them, fertile land can remain poorly used for centuries. Book 3, Chapter 3, of the Rise and Progress of Cities and Towns after the Fall of the Roman Empire. The inhabitants of medieval towns initially occupied a weak position. Many were little better than dependent traders paying arbitrary dues to lords. Over time, kings granted towns privileges, fixed payments, rights of self-government, and the ability to fortify themselves. Monarchs often supported towns because both had an interest in limiting the power of great territorial barons. Urban residents organized into corporations, raised militias, and acquired political independence. Security allowed commerce and manufacture to grow. In some regions, especially Italy and the Low Countries, towns became wealthy republics or powerful commercial centers, while the surrounding countryside remained under feudal domination. Foreign trade often preceded extensive domestic improvement. Merchants imported luxuries for nobles and exported the limited produce that local conditions made valuable. Demand from wealthy landowners supported artisans in towns. As manufactures developed, cities produced goods for wider markets and accumulated mobile capital. This urban growth was not the natural first stage Smith described, but it became a historical route to development. Towns created islands of order and liberty within feudal Europe. Their institutions protected property, attracted labor, and gave merchants a degree of independence unavailable in the countryside. Book 3, Chapter 4. How the commerce of towns contributed to the improvement of the country. Commerce and manufactures transformed the countryside through three main channels. First, towns created a market for agricultural surplus. Farmers could sell more produce and buy tools, clothing, and conveniences, giving them a motive to improve land beyond subsistence. Second, merchants used accumulated capital to purchase and improve estates. Their habits of calculation and attention to profit often made them more active improvers than hereditary landlords. Capital gained in trade was converted into buildings, drainage, enclosure, and cultivation. Third, commerce gradually dissolved the political power of the great barons. Before luxury manufactures, a landlord with a large surplus had few ways to spend it privately. He maintained crowds of retainers and tenants, and this hospitality gave him military and judicial authority. Towns offered ornaments, clothing, furniture, and other luxuries that could absorb the entire surplus for the personal gratification of the owner. Landlords dismissed retainers and exchanged political power for consumption. To obtain more cash, they demanded fuller rents and granted longer leases that allowed tenants to improve land. Their vanity unintentionally promoted liberty. Independent farmers replaced dependent followers, and royal justice could operate where private armies had weakened. Smith presents this result with irony. Merchants sought profit, and landlords sought childish distinctions and luxury. Neither group intended to establish public order or agricultural improvement. Yet their interaction undermined feudal dependence and created more secure property relations. England benefited from commerce, navigable waters, and laws relatively favorable to merchants and farmers, but agricultural progress still followed urban development slowly. Italy provides an earlier case where foreign trade and manufactures helped improve the whole territory. Smith nevertheless warns that commercial wealth is mobile. A merchant can transfer capital after a small political disturbance, while improvements fixed in land remain. The wealth of former trading cities can disappear when commerce moves elsewhere. Cultivated fields, roads, buildings, and durable improvements survive ordinary political changes. For this reason, a nation's commercial capital becomes more secure when part of it is realized in the lasting improvement of land. Book 3 therefore ends by showing how an inverted historical sequence could eventually approximate the natural order. Commerce that had grown first in towns created markets, capital, and political conditions for agriculture to advance. The historical argument of Book 3 depends on the interaction between property and power. Under feudal conditions, land was not merely an income-producing asset. It was the basis of military command, jurisdiction, and social dependence. Rules that preserved large estates therefore preserved a political order. Economic reform could not proceed simply by teaching better farming methods. Tenants needed security, and landlords had to lose the ability to confiscate the fruits of improvement. Primogeniture and entails kept land from moving toward more capable owners. A merchant could accumulate capital and knowledge yet be unable to purchase an estate freely, while an heir could control vast land without the resources or discipline to improve it. Smith treats alienability as an important condition for productive use. Property is secure not only when protected from seizure, but also when owners can sell it and creditors can reach it under clear law. Towns gained liberty partly because kings needed revenue. A fixed tax paid by a prosperous town was more useful to the crown than arbitrary dues collected through a feudal lord. Charters converted uncertain exactions into predictable obligations. The arrangement served royal interest, but it also created spaces where merchants could plan, contract, and accumulate. Urban corporations could themselves become restrictive. as Smith later criticizes. Yet in the medieval context, they protected citizens against greater arbitrary power. The same institution can therefore promote liberty in one historical setting and monopoly in another. Smith's method is institutional and comparative, rather than based on a single abstract label. The consumption of imported luxuries by great landlords had an unintended constitutional effect. A baron who fed hundreds of dependents purchased loyalty and military force. The same revenue spent on a jeweled ornament, fine cloth, or elaborate furniture supported anonymous artisans but no private army. Commerce converted a surplus that sustained command over people into a surplus spent on things. Long leases then emerged from bargaining. Landlords wanted higher cash rents, but tenants could pay them only after making improvements. Security for a period of years allowed the tenant to recover the investment. The development of leasehold institutions thus connected luxury demand, declining feudal power, and agricultural productivity. Smith's final contrast between mobile commercial wealth and fixed improvement is not hostility to merchants. It is an observation about durability. Ships, inventories, and financial claims can be moved or destroyed quickly. Drained fields, roads, walls, and buildings remain embodied in a territory. A balanced development converts part of the gains from trade into assets that survive ordinary shifts in routes and political fashion. Books 2 and 3 add a dynamic element to the price and distribution framework. Division of labor cannot expand indefinitely through exchange alone. Workers must be maintained while production is incomplete. Materials must be accumulated, and tools must be available. Capital is the bridge between present maintenance and future output. The distinction between fixed and circulating capital is functional. A machine remains with its owner and yields revenue through repeated use. Materials and finished goods yield revenue by changing hands. Money circulates, but its value to society lies in moving real goods. Human skill is fixed capital because education creates a durable productive capacity embodied in the worker. Smith's inclusion of acquired abilities is significant. Training is not merely consumption or ornament. It requires an advance and produces a stream of higher output. The worker cannot be separated from the skill, but the economic logic resembles a machine. Cost today, productive service over time. The monetary chapter applies the same real resource reasoning. Metallic money is costly infrastructure. Gold and silver used as currency cannot simultaneously be used or exchanged for other resources. Paper can perform the circulating function with less real cost, releasing bullion for export. The saving is analogous to a cheaper machine that performs the same task. The gain is conditional on trust and redemption. A banknote is useful because holders believe it can be exchanged for coin and accepted by others. Excess issuance returns to the bank, forcing redemption. Convertibility, therefore, limits paper to the amount the circulation requires. Bank credit creates liquidity, but does not create the underlying capital from nothing. A loan allows a borrower to command resources. If those resources are used productively and the advance returns through sale, repayment is possible. If the loan finances a project whose return is distant or speculative, short-term bank liabilities become mismatched with long-term assets. Smith's attack on chains of accommodation bills is an attack on the illusion of repayment. Participants issue new paper to discharge old paper, so each settlement depends on renewed credit rather than completed production. The structure can expand while confidence lasts and collapse when one party refuses continuation. The productive and unproductive labor distinction then asks whether expenditure reproduces the advance. Productive labor leaves value in a vendible object. Unproductive labor may be useful, honorable, or necessary, but its service is consumed immediately. The distinction supports an accumulation theory, not a moral hierarchy. Saving directs revenue toward the maintenance of productive labor. The saver does not cause goods to go unused. The goods are consumed by workers whose output replaces them with profit. Prodigality also creates demand, but it consumes without reproduction. The difference appears in next year's productive capacity. Smith gives individuals a stronger presumption of prudence than governments. A private person bears the loss from waste. All ministers can spend revenue raised from others. Yet he does not claim individuals are infallible. Speculation, vanity, and biased expectations remain common. The institutional advantage is that errors are more limited and directly disciplined. Interest is the price for the use of capital, not the price of money as a physical object. More coins do not necessarily lower the real interest rate if prices rise proportionally. Accumulation lowers interest by increasing the supply of lendable resources, and by reducing ordinary profit through competition. The ranking of capital employments is also about domestic reproduction. Agriculture and manufacture directly maintain productive labor and replace capital. Home trade keeps both ends of exchange within the domestic economy and turns over rapidly. Foreign trade and carrying trade can be beneficial, but the same capital may return more slowly and support less home labor. Book 3 shows that capital does not develop in a political vacuum. The natural order begins with land, proceeds to local manufacture, and then to foreign trade. Feudal Europe reversed this sequence because property institutions obstructed agriculture while towns gained islands of liberty. Primogeniture entails insecure tenancy, arbitrary dues, and private jurisdiction kept land from owners and tenants with the strongest incentives to improve it. Urban charters, by contrast, fixed obligations and protected merchants. Commerce accumulated capital under conditions more secure than those of the countryside. Luxury consumption then weakened feudal command. A baron who distributed food to retainers acquired obedience. A baron who spent the same revenue on manufactured ornaments acquired objects instead of followers. This private change in consumption unintentionally reduced private armies and expanded public justice. The rise of long leases transformed the tenant's calculation. Security for a sufficient term made drainage, buildings, and soil improvement recoverable. The landlord accepted security because improvements supported higher rent. Institutional change connected self-interest to durable productivity. Smith's historical method therefore complements his market theory. Markets require property, mobility, security, and enforceable contracts. These conditions emerge through political conflict and institutional evolution. Natural liberty is not imagined as an original state. It is a practical order that can be blocked or approximated by law. Book 4, Chapter 1. Of the principle of the commercial or mercantile system. Smith opens Book 4 by examining the idea that national wealth consists in money, especially gold and silver. The belief seems natural because money purchases all other goods, and a rich individual is often described as someone who possesses much money. States therefore tried to accumulate bullion, prohibit its export, and judge commerce by whether metal entered or left the country. Smith argues that this confuses the instrument of exchange with the goods that constitute real wealth. A nation's annual income consists in the produce of its land and labor. Gold and silver are useful because they circulate that produce and settle foreign transactions. But a country is not fed, clothed, or defended by metal alone. If goods are available, money will generally be found to circulate them. If goods are absent, a stock of money cannot replace them. Private merchants understand this in their own affairs. A trader does not normally keep the whole capital idle as cash. Money retained beyond the needs of payment yields no profit. The same logic applies nationally. Bullion will be imported when it is useful and exported when foreign goods are more valuable. Prohibitions on export are difficult to enforce because precious metals are compact and easily smuggled. The anxiety about bullion became especially strong because foreign wars require purchases abroad. Smith replies that wars are supported by the annual produce and accumulated capital of the country, not simply by the coins physically present before hostilities. A commercial nation can finance external expenditure by exporting goods, drawing foreign income, selling assets, or borrowing. The capacity to produce and command resources is more important than the domestic stock of metal. Mercantilists also focus on the balance of trade. If exports exceeded imports, they assumed the difference returned in bullion and enriched the country. If imports exceeded exports, they assumed treasure was lost. Smith challenges both the measurement and the conclusion. Customs records are incomplete, smuggling is widespread, valuations are arbitrary, and trade routes involve many countries. A bilateral deficit can be part of a profitable multilateral system. Even an accurately measured excess of imports does not necessarily imply impoverishment. Imports may consist of raw materials and tools that enlarge production. Exports may represent capital being consumed abroad. Goods can also be financed by income from shipping, insurance, foreign investments, and other claims not visible in merchandise accounts. The relevant question is whether the society's productive stock and annual output are rising. The doctrine nevertheless serves powerful interests. Merchants and manufacturers benefit from policies that restrict competitors, encourage exports, and grant exclusive privileges. They persuade legislators that their private advantage is national advantage. Smith repeatedly warns that proposals from these groups deserve careful scrutiny because they have both specialized knowledge and an interest in narrowing competition. The mercantile system therefore directs policy toward accumulating money, promoting exports, restraining imports, and securing markets. Smith's response is not that foreign trade is unimportant. Trade enlarges markets, permits specialization, and gives value to surplus produce. His objection is that the purpose of production is consumption. Commerce should be judged by the goods and opportunities it provides, not by whether it increases the quantity of metal in the treasury. Book 4, Chapter 2. Of restraints upon importation from foreign countries of such goods as can be produced at home. Import duties and prohibitions give domestic producers a monopoly in the home market. They can increase the employment and profit of the protected industry, but they do not necessarily increase total national industry. The capital drawn into the protected trade must come from some other use. Policy changes the direction of employment more readily than it increases the amount of capital available. Every individual tries to employ capital where it is secure and profitable. A merchant generally prefers domestic employment when returns are comparable, because the capital remains under his observation and domestic law. In pursuing profit, he is led to direct industry toward products with the greatest value. Smith formulates the point through the famous image of an invisible hand. By seeking his own gain, an individual can promote an outcome that was not part of his intention. No statesman can possess the detailed local knowledge required to direct every person's capital. A lawmaker who tries to determine what each citizen should produce assumes an authority that would be unsafe even in capable hands. If a foreign country can supply a commodity more cheaply than domestic producers, the home country usually gains by buying it with the products in which it has an advantage. Smith compares this to household management. A prudent family does not make at home what costs more than purchasing it. A tailor buys shoes, and a shoemaker buys clothing. The fact that a good can physically be produced domestically does not show that doing so is economical. Resources should be compared through opportunity cost, even though Smith does not use that later term. Protection can create an industry earlier than it would otherwise arise, but the country pays through higher prices and diverted capital. The permanent product of society may be lower because resources are kept from more productive uses. Consumers bear the monopoly, while the protected producers receive the visible benefit. Smith recognizes two principal exceptions. The first is national defense. Certain industries, especially shipping and naval capacity, may be necessary for security, even if protection imposes an economic cost. He defends the Navigation Acts on this ground, observing that defense is more important than opulence. The policy favored British shipping and restricted foreign carriers, but it supported maritime power. The second exception concerns equal taxation. If domestic producers pay a tax on a commodity, an equivalent duty on the imported version may prevent the tax from operating as an unintended preference for foreigners. The purpose is not protection beyond equality, but neutral treatment of competing goods. Determining equivalence can nevertheless be difficult when taxes fall on inputs and production stages. Retaliation is a more uncertain case. A temporary restriction may be justified if it is likely to induce another country to remove a serious barrier. The decision requires judgment about bargaining power and probability. If retaliation fails, both countries remain injured. Smith doubts that legislators influenced by protected interests will remove the restriction once it has served its negotiating purpose. The removal of established protection also raises a transition problem. Immediate repeal can destroy capital and employment that entered the industry under existing law. Humanity and public order may justify gradual reduction, particularly when many workers depend on the trade. Smith distinguishes this from a supposed right to perpetual monopoly. The longer protection lasts, the more difficult reform becomes, because private expectations grow around the distortion. The chapter ends with a political observation. Perfect freedom of trade may never be fully restored in Britain, because the interests opposed to it are organized and influential. Consumers are numerous but dispersed. Each loses only a little from a particular tariff. Producers are concentrated and gain greatly, so they lobby effectively. Economic reasoning alone does not determine policy when benefits are concentrated and costs spread across the public. Book 4, Chapter 3. Of the extraordinary restraints upon the importation of goods of almost all kinds from countries with which the balance is supposed to be disadvantageous. The mercantile system often goes beyond protecting specific domestic industries. It imposes special barriers against countries believed to sell more to the home country than they buy from it. Smith first argues that this policy is unreasonable even on mercantilist assumptions. Restricting direct trade does not ensure that bullion remains at home. Goods and money move through third countries, and the overall balance cannot be inferred from one bilateral account. A country may import heavily from one partner because that partner supplies useful goods cheaply, while exporting to another market where its own goods are valued. The chain can be beneficial at every stage, demanding that each bilateral relationship balance is like requiring every merchant to sell to the same individuals from whom he buys. Exchange rates are also unreliable evidence. The quoted rate between currencies reflects the condition and legal valuation of coins, costs of remittance, and the structure of payments. A currency can appear at a discount without demonstrating a real loss of national wealth. Debased or worn coins further confuse comparison. Smith uses the rivalry between Britain and France to illustrate how national animosity reinforces commercial error. Each country treats the other's prosperity as a threat, even though a rich neighbor can be an excellent customer. Trade between nearby populous countries can be especially valuable because transport is cheap and returns are rapid. Political hostility leads both sides to sacrifice gains in order to injure the other. The deeper error is the assumption that commerce is a contest in which one nation's gain must be another's loss. Voluntary exchange can benefit both. A country that sells goods receives goods it values more. The partner makes the opposite assessment. The gain is not measured by which side receives bullion, but by the improvement in consumption and productive opportunity. Smith is not indifferent to strategic conflict. A neighboring state can be a military rival, and defense may require sacrifices. His argument is that ordinary commercial policy should not imitate warfare. Enriching domestic monopolists by excluding a rival's goods does not necessarily strengthen national security and can reduce the resources available for defense. He examines preferential arrangements, such as Britain's trade with Portugal. Under the Methuen Treaty, Portuguese wine received favorable treatment while British woolens entered Portugal. Mercantilists praised the treaty because Portugal paid part of its deficit in gold from Brazil. Smith replies that Britain could have purchased wine elsewhere and used its goods in other markets. The arrival of gold was not proof that the arrangement maximized national advantage. Bilateral prohibitions also create smuggling and administrative expense. Consumers continue to demand the goods, merchants reroute them, and officials gain opportunities for corruption. The policy may therefore fail even on its own terms, while making trade more costly and law less respected. The general conclusion is that a nation should evaluate the total employment of its capital and the real goods obtained through trade. Special hostility toward an adverse bilateral balance rests on faulty accounting, ignores indirect exchange, and treats the wealth of customers as a danger. Commercial jealousy can become a permanent source of international conflict because every expansion of a neighbor is interpreted as a national loss. Book 4, Chapter 4, of Drawbacks. A drawback refunds duties previously paid on imported goods when those goods are later exported. Smith generally approves this policy because it prevents a tax intended for domestic consumption from burdening goods that never enter domestic use. Without the refund, merchants would avoid using British ports and warehouses, and the carrying trade would move elsewhere. A full drawback restores the trader to nearly the position that would exist under free importation. It does not create an artificial advantage so much as remove an accidental burden. The customs service must still guard against fraud, because merchants may claim that goods were exported when they were secretly sold at home. Administrative difficulty can justify practical limits, but not a general refusal to refund. Drawbacks on domestic excises require similar reasoning. If a manufacturer pays tax on an input and exports the final product, refunding the tax allows competition in foreign markets without subsidizing the underlying production. The payment should correspond to the actual tax rather than exceed it. Once the refund becomes larger than the duty, it turns into a bounty and begins to distort production. Smith notes that mercantile governments sometimes grant only partial drawbacks when goods are exported to particular countries or in particular forms. Such discrimination reflects trade jealousy rather than sound finance. The simpler rule is to tax goods consumed at home and avoid taxing goods merely passing through the country. Book 4, Chapter 5, of Bounties. Export bounties pay producers or merchants to sell goods abroad. Their defenders claim that the payments create a favorable balance of trade, support employment, and help domestic goods overcome foreign competition. Smith argues that the need for a bounty is evidence that the good costs more to produce at home than foreign buyers are willing to pay. The public is taxed so that foreigners can purchase the product below its domestic cost. A bounty can expand the favored industry, but it does so by drawing capital and labor from other uses. The visible workers employed in the subsidized trade are offset by less visible employment foregone elsewhere. National output may fall because resources are directed toward an activity unable to sustain itself at market prices. The corn export bounty received Smith's most extensive criticism. Supporters argued that encouraging exports raised the domestic price of grain, increased cultivation, and ultimately produced abundance. Smith replies that the bounty raises the home price in ordinary years by allowing merchants to sell abroad with public assistance. Consumers pay once through taxes and again through dearer bread. The higher nominal price does not necessarily raise the real return to agriculture in the intended way. Labor wages and other costs adjust to the price of subsistence. If corn is generally dearer, the farmer pays more to maintain workers. Landlords may gain through rent, but the country does not create fertility by altering the money price. Cultivation expands when real demand and productive conditions justify it, not because government pays exporters to dispose of a surplus. The bounty can also destabilize supply. In years of moderate plenty, subsidized export removes grain that might otherwise remain for domestic consumption or storage. When a poor harvest follows, the country faces scarcity sooner. Governments then suspend exports or prohibit them, producing abrupt changes that make trade less reliable. Smith distinguishes a bounty from a drawback. A drawback repays a tax and restores neutrality. A bounty adds a payment not previously taken and creates an artificial advantage. The distinction is important because both appear as money paid at export, but their economic effects are opposite. He examines other subsidized trades, including fisheries. The herring bounty was defended as support for seamen and naval strength. Smith reviews the quantity of fish caught, the public payments, and the profitability of the vessels. He concludes that much of the bounty rewarded the fitting out of boats rather than the efficient capture and sale of fish. Some fish were exported at prices that could not cover the real cost without subsidy, while the public expense per barrel was extremely high. Bounties can sometimes be defended for defense-related production or for a genuinely temporary experiment whose knowledge benefits the country. Smith remains skeptical because temporary support tends to become permanent, and because producers have better information than legislators about whether a trade is viable. An entrepreneur who expects future profit has reason to bear initial losses. The public should not routinely ensure private speculation. Mercantilists also argue that bounties lower prices abroad and win markets that can later be retained. Smith answers that competitors can respond, foreign demand can disappear, and the industry becomes politically dependent on continued payment. The apparent export success is purchased rather than earned. The chapter includes a digression on grain laws and the role of merchants in the corn trade. Popular suspicion often treats grain dealers as responsible for scarcity, but Smith argues that merchants help move grain from places of plenty to places of need, and from abundant years to scarce ones. Their profit depends on buying when grain is relatively cheap and selling when it is dear, an activity that tends to moderate extremes. Laws that prohibit forestalling, engrossing, or reselling grain can deter the storage and transport needed for security. A merchant who misjudges the market bears losses, while a government that misjudges supply can impose scarcity on the whole country. Freedom of the grain trade is therefore generally the best safeguard, except in the most extraordinary emergency when export could threaten immediate subsistence. Smith is careful about famine. A dearth is a serious shortage caused by harvest conditions. A famine often results when violent government measures disrupt distribution. Merchants cannot profit by allowing customers to die, and competition prevents them from withholding all supply indefinitely. Authorities may blame traders because they are visible, but arbitrary seizures and price controls can destroy the incentives to bring grain into the affected region. The broad lesson is that subsidies conceal cost. A nation cannot become richer by taxing itself to maintain production whose value is lower than the resources used. The measure of success is not the quantity exported, but the net contribution to annual produce and consumption. Book 4, Chapter 6. Of Treaties of Commerce. Commercial treaties often grant one foreign nation lower duties or exclusive privileges in exchange for similar treatment. The favored country may gain relative to other suppliers, but the importing nation can lose if it is prevented from buying from the cheapest source. A treaty redistributes trade. It does not prove that total trade or national wealth increases. Smith again discusses the Portuguese treaty. British consumers were encouraged to buy Portuguese wine rather than potentially cheaper French wine, while Portugal favored British manufacturers. British merchants benefited from a secure market, and bullion flowed from Portugal, but consumers paid more and capital was directed by privilege. The gold inflow became the public justification for an arrangement serving particular trades. A treaty can still be advantageous when it reduces barriers that would otherwise remain high. If mutual concessions create more freedom than either country would allow unilaterally, both can gain. Smith's criticism is directed at exclusive preference and the belief that a monopoly over a foreign market is an unambiguous national benefit. When a country possesses a monopoly in another nation's market, merchants may receive higher profits, but those profits attract excess capital into the privileged trade. The monopoly raises the rate of profit in one branch and can raise the general profit rate by reducing competition elsewhere. Consumers at home then bear part of the cost through higher prices. The negotiator's objective should be broad access and lower barriers, not the capture of a partner's market for selected producers. Treaties designed under mercantile influence tend to exchange one monopoly for another. Smith prefers commercial relations in which goods follow comparative cost and consumer demand rather than diplomatic privilege. The first 6 chapters of Book 4 can be read as a systematic dismantling of the idea that government should manage commerce to accumulate money and secure a permanent surplus of exports. Smith attacks the theory at 3 levels: its definition of wealth, its accounting of trade, and the incentives of the groups that promote it. At the definitional level, money is a claim on goods, not the goods themselves. A country with productive land, skilled workers, machinery, and reliable trade can obtain the money required for circulation. A country with much bullion but weak production cannot consume the metal directly. The same distinction applies to an individual who is temporarily rich in cash but poor in income-producing assets. At the accounting level, bilateral trade balances omit the network through which commerce is settled. Britain can buy from one country, sell to another, and use shipping income or financial claims to balance the whole. The route followed by bullion reveals payment arrangements, not a complete national profit and loss statement. At the political level, the mercantile system gives producers a language with which to present monopoly as patriotism. A tariff that raises the price of their product becomes protection of national industry. A subsidy that transfers taxes to their exports becomes the creation of employment. A restriction on raw material exports becomes preservation of domestic value. The public purpose is stated broadly, while the private gain is concentrated. Smith does not assume that capital instantly moves without cost. Buildings, specialized tools, and skills can be tied to an industry. This is why he allows gradual removal of long-established protection. The transition argument, however, does not justify creating new protection or preserving it forever. Temporary adjustment must be distinguished from a permanent right to monopoly. The invisible hand passage is often isolated from these qualifications. Smith's claim is that a person who prefers secure domestic employment and seeks the most valuable output can unintentionally promote national production. The claim presupposes competition and the absence of artificial privilege. A monopolist seeking profit can harm the public precisely because law prevents others from responding. The household analogy also has limits that Smith recognizes. Defense can justify producing something domestically even when foreign supply is cheaper. A nation may accept a commercial loss to preserve ships, weapons, or strategic capacity. This exception confirms rather than abandons the method. The policy should be defended openly as the cost of security. Equalizing taxes is another narrow exception. If a domestic commodity bears an excise, an equivalent import duty can prevent tax policy from shifting production abroad. But the equivalent duty should not exceed the domestic burden. Otherwise, neutrality becomes protection. Retaliation requires a credible prospect of success. A restriction that induces a partner to remove barriers may expand freedom. A restriction adopted merely to punish another country can become a reciprocal injury. Smith doubts the wisdom of ministers who must predict foreign response while under pressure from domestic industries that benefit from continued conflict. Commercial hostility toward France illustrates the role of emotion. Proximity and wealth make France a potentially valuable customer and supplier. National rivalry converts these advantages into suspicion. Each country regards the other's growth as evidence of its own decline, even when both could gain through exchange. The balance of trade doctrine also encourages states to value distant colonies over nearby markets. A colony can be compelled to purchase metropolitan goods, creating a recorded export. A neighboring independent country may buy more efficiently, but cannot be controlled. The desire for political command replaces the economic question of mutual advantage. Drawbacks are treated favorably because they preserve the entrepot function. A merchant can import goods, store or process them, and re-export without paying a tax intended for domestic consumption. Ports gain business, shipping gains cargo, and the tax system remains focused on final use. Administrative design determines whether a drawback remains neutral. The refund must correspond to duties actually paid. If proof requirements are impossible, legitimate trade is obstructed. If verification is weak, goods supposedly exported can leak into the domestic market. Smith's support is therefore conditional on accurate and economical administration. Bounties reverse the logic. They do not remove a prior burden. They add public money to a transaction. The foreign buyer receives a lower price, while domestic taxpayers finance the difference. The larger the subsidized export, the larger the fiscal cost. Quantity alone is therefore not evidence of success. The corn bounty is particularly important because food prices affect wages and the whole economy. Encouraging export can raise domestic grain prices in ordinary years. Laborers require higher money wages, employers face higher advances, and consumers pay more. Landlords and grain merchants may benefit, but the effect is distributed through many prices. Smith rejects the claim that a higher money price automatically makes agriculture more productive. If all domestic costs rise with grain, the real incentive may be smaller than it appears. Durable improvement comes from security, capital, markets, and techniques, not from manipulating the nominal price. His defense of grain merchants is part of the same argument about dispersed knowledge. A merchant observes prices across regions and time. Buying in a plentiful place and selling in a scarce place directs grain toward greater need. Storage carries supply from harvest to later months. Profit rewards the coordination that public officials often denounce. A government order can move grain too, but officials lack the same information and do not bear the same loss from error. Price controls may empty markets because sellers withhold or divert supply. Seizure can discourage future imports. A policy adopted to make food cheap can make it unavailable. Smith distinguishes dearth from famine to emphasize institutions. A bad harvest reduces total food and necessarily raises hardship. Famine can be intensified or created when authorities prevent trade, requisition supplies, or destroy the incentives of merchants. The moral anger directed at dealers should be tested against the physical movement of grain. The herring bounty offers an empirical test of subsidy. Payments based on vessels or output can reward activity that has little relation to efficient production. Boat owners may fit ships to qualify for the bounty, while the value of fish landed remains low. Public accounts should compare the subsidy with actual marketable output, not with the number of boats launched. Commercial treaties create a similar accounting illusion. A privileged market appears valuable because exports to it are visible. The cost paid by consumers through dearer imports or by excluded traders is less visible. A treaty can still be useful when it lowers barriers, but exclusivity should not be confused with liberalization. The Portuguese wine arrangement demonstrates how bullion can distract from real terms of trade. Gold arriving from Portugal delighted mercantilists, yet British consumers may have paid more for wine than under open competition. The metal flow served as a symbol that prevented examination of price and opportunity cost. Monopoly profit can also alter the national distribution of capital. Protected branches attract funds until their advantage is partly competed away among privileged participants. Other sectors face less capital and may earn higher profit. The distortion, therefore, extends beyond the protected product. Smith's repeated focus on profit rates connects Book 4 to Book 1. High profit can raise prices through successive stages and indicate weak competition. Policies that preserve high merchant profit can injure national competitiveness even when they are advertised as support for trade. The political asymmetry between producers and consumers explains durability. A tariff may add a small amount to each household's expenses. No household has a strong incentive to organize around that one item. The protected industry receives a large aggregate transfer and can finance lobbying, publications, and influence. This asymmetry makes reform difficult even when the economic argument is clear. Existing capital, employment, and local communities become tied to the privilege. Ministers fear concentrated losses more than diffuse gains. Smith's expectation that complete free trade may be unattainable is therefore institutional, not merely pessimistic. The system of natural liberty does not promise that every domestic producer will survive. It promises that resources can move toward uses valued enough to cover their costs. Losses remain real, and transition can be painful, but preventing all adjustment freezes the economy around past decisions. Foreign competition can also discipline domestic producers. Without it, corporations and manufacturers can combine, reduce quality, and raise price. Consumers gain not only from cheaper imports, but from the pressure imports place on local industry. Trade policy should finally be evaluated through consumption and production together. Imports are not a payment with no return. They are part of the benefit of trade. Exports are not the benefit itself. They are what the country gives to obtain imports or foreign claims. A nation that exports more while receiving less is not necessarily enriched. Smith's mercantile critique is therefore a critique of one-sided bookkeeping. It restores the costs borne by consumers, the capital displaced from other industries, the taxes, financing subsidies, and the political expense of enforcing monopoly. Once these are counted, many apparent national gains become transfers or losses. Book 4, Chapter 7, of Colonies. Smith begins by separating ancient colonies from the European colonies of the modern age. Greek colonies were often founded because population pressure, political conflict, or defeat made immigration necessary. The settlers generally became independent communities. They retained language and cultural ties with the mother city, but governed themselves and owed no continuing revenue. Roman colonies had a different purpose. Rome planted citizens and soldiers in conquered territories to secure military control and redistribute land. The colony remained connected to Roman authority and served imperial expansion. In both Greek and Roman cases, the motives were clearer and the institutional relation more direct than in the later European conquest of distant continents. Modern colonies arose largely from the search for a route to Asia and for precious metals. Columbus expected to reach the East Indies and interpreted the lands he encountered through that expectation. Europeans were attracted by stories of gold, silver, and wealthy kingdoms. Smith treats the project as a combination of accident, ambition, religion, and commercial fantasy. The pursuit of gold shaped early colonial policy. Conquerors demanded treasure from indigenous rulers and forced labor into mines. The expectation of sudden wealth encouraged violence and diverted attention from agriculture and ordinary commerce. Most mining ventures failed because the chance of discovering a rich deposit was small and the costs uncertain. The spectacular success of a few mines sustained a general delusion similar to the attraction of lotteries. Smith condemns the destruction suffered by indigenous peoples. The discovery of America and the sea route to Asia opened two immense markets and could have benefited all regions through exchange. Instead, the military superiority of Europeans enabled conquest, enslavement, and monopoly. The potential gains of commerce were accompanied by some of the most dreadful misfortunes in human history. The economic success of colonies did not depend chiefly on gold. It came from abundant fertile land relative to population. In a new settlement, land is cheap, wages are high, and profits are high because the best locations are cultivated first and labor is scarce. A worker can acquire land and become independent more easily than in an old country. Population grows rapidly because families can support children and employment expands with cultivation. Colonial prosperity, therefore, illustrates Smith's earlier analysis of wages and profit. The same scarcity of labor that raises wages can coexist temporarily with high profits because land offers unusually productive opportunities. As capital and population accumulate, inferior land is brought into use, competition increases, and profit rates gradually decline. Institutions determine how fully these advantages are realized. Colonies prosper when settlers enjoy secure property, moderate taxes, and freedom to sell produce. They stagnate when governors, chartered companies, or metropolitan monopolies control land and trade. Smith compares Spanish, Portuguese, French, Dutch, and British colonies through this framework. Spanish and Portuguese colonies possessed rich mines, but were burdened by restrictions, taxation, and concentrated authority. The Crown claimed a share of precious metal output and regulated trade through selected ports and fleets. Monopoly raised the price of European goods in the colonies and lowered the price received for colonial produce. Smuggling became a normal response. The Dutch colonies were often governed for the benefit of an exclusive trading company. A company seeking monopoly profit might deliberately restrict production to maintain high prices in Europe. It could destroy crops, limit settlement, or prevent independent trade. Policies rational for the company's shareholders could be destructive to the colony and consumers. French colonies sometimes received more active administrative support, but remained subject to regulation and monopoly. British North American colonies generally enjoyed greater liberty. Distance, divided authority, representative assemblies, and the practical limits of enforcement allowed settlers to manage local affairs and retain a larger share of their output. Land policy was important. When large grants were held by absentee owners or restricted by entail, settlement slowed. When land could be acquired on accessible terms and transferred freely, families improved it quickly. In British colonies, the possibility of becoming a proprietor strengthened incentives and attracted migrants. Religious and political dissent also contributed to settlement. People willing to cross the Atlantic for liberty brought determination and habits of self-government. Smith does not romanticize every colonial institution, but he emphasizes that a society of independent proprietors differs fundamentally from one organized around forced labor and monopoly. The labor system created a severe contradiction. High free wages encouraged the use of enslaved Africans in plantation colonies. Smith argues that slave labor appears cheap to the master, but is generally costly because people who cannot benefit from effort have little incentive to work carefully or improve methods. The pride of domination prevents owners from recognizing the full cost. Where climate and crops supported large plantations, slavery nevertheless became deeply established. The rapid growth of colonies created markets for European manufactures. Settlers demanded tools, clothing, household goods, and shipping. In return, Europe received tobacco, sugar, rice, timber, dyes, and other products. The enlargement of the market promoted division of labor in both the colonies and the mother countries. These gains came from colonization and trade, not from monopoly. European nations attributed colonial prosperity to exclusive control, but Smith argues that freedom would have produced greater output and cheaper goods. Monopoly diverted colonial trade toward the mother country, even when another market offered better terms. Colonists received less for exports and paid more for imports. Smith distinguishes the natural advantages of colonial trade from the artificial advantage created by monopoly. The natural advantage is geographic and developmental. Growing colonies demand European manufacturers and supply products that Europe values. The artificial advantage is the legal exclusion of foreign merchants. British producers gain privileged access, but the gain is partly transferred from British consumers, colonial consumers, and other domestic industries. Monopoly raises profits in the favored trade. Capital flows toward colonial commerce not because it is the most productive use for the country, but because law protects returns. Other branches lose capital and face higher profit rates. The protected merchants appear prosperous, yet the structure can raise prices across the economy and reduce the total annual product. The monopoly also changes the composition of risk. A large share of national capital becomes dependent on political control of distant territories, and on regulations that can be disrupted by war. Merchants who would otherwise diversify among markets concentrate on the colonies. When conflict closes routes or a colony rebels, losses spread widely. Navigation laws reserved colonial shipping and trade for British vessels and specified commodities. Smith had earlier defended parts of the Navigation Acts as measures of defense, but he separates that strategic argument from claims of economic benefit. A rule may strengthen naval capacity while reducing opulence. Honest evaluation requires recognizing the cost, rather than pretending that security and wealth always point in the same direction. The monopoly's political influence reinforces itself. Colonial merchants and manufacturers receive large, concentrated benefits and therefore organize to preserve the system. The public pays through diffuse taxes and higher prices. Parliament hears detailed claims about employment and trade from interested groups, while consumers have little incentive to oppose each restriction individually. Smith argues that the discovery of America increased European prosperity, even in countries without colonies. New products, new markets, and expanded commerce enlarged the division of labor. Non-colonial countries participated indirectly through trade with colonial powers. This shows that the general benefit came from the enlargement of the commercial world, not from exclusive possession. The Cape route to the East Indies likewise connected distant regions, but European companies often governed Asian territories as merchants with sovereign power. An exclusive company has a conflict between its role as ruler and its role as trader. As ruler, it should promote the prosperity of the population, because taxes depend on broad production. As trader, it may restrict production and competition to raise the price of goods it monopolizes. The East India Company illustrates the danger. Company servants could use political power for private gain, while the corporation focused on dividends and monopoly. The inhabitants of governed territories bore arbitrary exactions and commercial restrictions. A body of merchants is poorly suited to sovereign administration because its immediate interest can oppose the long-term wealth of the country it rules. Smith then asks whether colonies yield a fiscal return sufficient to compensate the mother country. In the British case, colonial taxes contributed little to the ordinary revenue of Britain, while defense and administration generated large costs. The colonies were expected to buy British goods and support shipping, but those advantages mainly enriched particular groups. The public treasury paid for fleets, armies, forts, and wars. The 7 Years' War demonstrated the scale of imperial expense. Britain fought in North America and elsewhere to defend and expand colonial claims. The national debt increased, while colonial assemblies resisted metropolitan taxation. If the empire exists for the monopoly of merchants, Smith asks why the general population should pay for it. The dispute over taxation exposes incompatible principles. Britain claimed authority to tax colonies represented virtually in Parliament. Colonists insisted that taxes required consent through their own assemblies. Smith treats the colonies as already too large and politically mature to be governed indefinitely through distant coercion. One possible solution would be an imperial union. Colonial representatives could enter the British Parliament in proportion to taxation, creating a single political system. Over time, population growth might shift the center of the empire westward. Smith presents the idea seriously but recognizes the obstacles. British elites would resist sharing power, colonial elites would resist losing local authority, and distance would make administration difficult. The alternative is peaceful separation. Britain could abandon the monopoly, establish free trade, and form a defensive alliance with independent colonies. The supposed loss would be smaller than imagined, because voluntary commerce would continue wherever mutually advantageous. Britain would save the cost of colonial administration and war, while merchants would lose only exclusive privilege. National pride makes such separation unlikely. Empires are valued as symbols of greatness, even when they burden taxpayers. Rulers and legislators prefer the appearance of dominion to an honest calculation of costs. Smith's discussion therefore combines economics with political psychology. Prestige can sustain arrangements that do not serve the material interest of the majority. He predicts that coercion will intensify resistance. A people accustomed to self-government and rapid growth will not easily accept taxation imposed by a distant legislature. Military victory cannot permanently solve the constitutional problem, unless Britain is willing to maintain continuing force. The cost of preserving authority may exceed any possible revenue. The chapter's general judgment is complex. Colonization enlarged markets and productive possibilities. The growth of settlements created real wealth. Yet conquest inflicted catastrophic harm, slavery corrupted labor, monopoly distorted trade, and empire imposed fiscal burdens. The beneficial element was the extension of exchange under secure property. The harmful element was the attempt to convert that exchange into exclusive political and commercial control. Smith's position is therefore not that colonies produced no advantages. It is that the advantages were wrongly attributed. Merchants credited monopoly for gains that arose from land, population, and commerce. If the monopoly were removed, the colonies could buy from the cheapest sellers and sell to the best markets. Their prosperity would increase, and Britain could still share in the expanded trade through competitiveness rather than force. Book 4, Chapter 8. Conclusion of the Mercantile System. Smith now draws together the logic of mercantile policy. The system presents itself as a plan for national wealth, but in practice it is a collection of regulations designed around the interests of producers, especially merchants and manufacturers. Consumption is the sole end and purpose of production, yet mercantile legislation repeatedly sacrifices consumers to producers. Import restraints force the public to buy dearer domestic goods. Export bounties tax the public so that foreigners can buy cheaply. Colonial monopolies make colonists buy from the mother country and sell through approved channels. Drawbacks are reasonable only when they remove prior taxes. Once they exceed those taxes, they become subsidies. The common pattern is that organized producers receive concentrated gains while the dispersed public bears the cost. Smith examines regulations affecting raw materials. Manufacturers often demand free importation of inputs because cheap materials lower their costs, while simultaneously supporting restrictions on finished foreign goods. They may prohibit exports of domestic raw materials so that local manufacturers can purchase below the world price. The producer asks for freedom when buying and monopoly when selling. Wool provides a prominent example. Restrictions on the export of British wool lowered the domestic price for manufacturers and injured sheep farmers. Severe penalties and enforcement treated a peaceful trade almost like a crime against the state. The policy was justified as protection of the woolen manufacture, but it redistributed income from agriculture to manufacturing and encouraged smuggling. Other materials received different treatment depending on political influence. Some imports were admitted freely, some received bounties, and some exports were prohibited. There was no coherent national principle. The pattern reflected which industry could persuade Parliament that its own cheap inputs and protected outputs were essential to the country. Smith does not deny that manufacturing interests can coincide with public interests. A productive industry may expand employment and improve technique. His warning is that the testimony of interested producers is not neutral. They naturally understand how a regulation benefits their trade, but may ignore how it raises prices, reduces competition, or injures other branches. The mercantile system also distorts language. The trade is called advantageous when it brings money into a particular merchant's hands, and disadvantageous when it exposes him to foreign competition. National gain is inferred from private profit. Smith restores the consumer and the total annual product as the relevant standards. The chapter concludes that the system's complexity is itself revealing. A simple policy of natural liberty would require fewer prohibitions, exceptions, certificates, and subsidies. Mercantilism creates administrative machinery because each privilege requires boundaries, enforcement, and further corrections. The result is not a planned national economy, but an accumulated structure of partial interests. Book 4, Chapter 9. Of the agricultural systems, or of those systems of political economy which represent the produce of land as either the sole or the principal source of the revenue and wealth of every country. Smith turns to the French agricultural system associated with the physiocrats. In reaction to mercantilism, these writers located the ultimate source of wealth in the land. They divided society into the productive class of cultivators, the proprietors who receive rent, and the unproductive class of artisans, manufacturers, merchants, and servants. The system called agriculture productive because it yields a surplus above the advances of labor and capital. Nature works alongside the farmer, and the net product appears as rent. Manufacturing was labeled sterile because it transforms materials, but, in the physiocratic account, adds only enough value to replace wages and capital without creating a net surplus. Smith praises several aspects of the doctrine. It recognizes that money is not wealth, emphasizes the annual produce of land and labor, and attacks the restraints of the mercantile system. Its advocates support free grain trade, secure property, and a broad system of natural liberty. They also understand that taxes ultimately burden the revenues generated by production. The central error is the claim that manufacturing and commerce are unproductive. A manufacturer's labor fixes itself in a vendible commodity and reproduces wages with profit. The value added may not appear as rent, but it is still part of the annual product. A country can increase wealth through improved manufacturing just as it can through improved cultivation. Smith also rejects the implication that artisans are maintained entirely from the agricultural surplus without giving anything equivalent in return. Farmers buy tools, clothing, and manufactured goods because these products have value. Exchange transfers the surplus in both directions. The manufacturer consumes agricultural produce, but supplies transformed goods that replace what was consumed. The physiocratic proposal for a single tax on land rent follows from its theory of the net product. If all taxes ultimately fall on rent, government might collect one transparent levy directly from proprietors. Smith agrees that simple and predictable taxation has advantages, but he doubts that all taxes can be reduced to rent without affecting wages, profit, and prices in more complicated ways. He discusses the detailed economic table through which the physiocrats traced annual circulation among classes. The model is ingenious and highlights reproduction, but it rests on the sterile class assumption. Once manufacturing is recognized as productive, the circulation of income cannot be reduced to a single agricultural surplus. Despite its errors, Smith considers the agricultural system the nearest approximation to truth among existing political economy doctrines. It opposes monopoly and seeks to remove artificial restraints. Its mistake is not excessive faith in liberty, but an overly narrow definition of production. Smith ends Book 4 with the system of natural liberty. When unjust preferences and restraints are removed, every person is free to pursue an occupation and employ capital according to interest, so long as the laws of justice are observed. The sovereign is relieved of the impossible task of directing private industry. Government retains three great duties: defense against foreign aggression, administration of justice, and the creation of certain public works and institutions that benefit society but would not repay an individual investor. Natural liberty is not the absence of government, it is a division of responsibility. Individuals direct ordinary production and exchange through local knowledge and competitive incentives. Government protects the framework, supplies public goods where private return is insufficient, and avoids converting political power into commercial privilege. Smith's colonial analysis becomes clearer when the different sources of colonial growth are separated. The first is abundant land. The second is institutional freedom. The third is access to a large market. None of these requires the mother country to monopolize trade. Abundant land raises the return to labor because a worker can become a proprietor. In Europe, land is already occupied and rents absorb part of agricultural output. In a new settlement, the same effort can bring a family closer to ownership. Employers must therefore pay wages high enough to keep workers from leaving to farm independently. High wages do not prevent rapid accumulation because the best land yields high output. Farmers and merchants can earn high profits while laborers earn well. This combination is temporary and characteristic of expansion into underused territory. As land fills, the pattern gradually approaches that of older countries. Population growth follows economic opportunity. Early marriage and the ability to maintain children increase the number of settlers. Immigration adds to natural increase. Smith treats population as responding to demand for labor rather than as an independent measure of political greatness. Colonial governments can accelerate or obstruct this process. Secure titles encourage clearing and building. Arbitrary governors or uncertain grants discourage permanent improvements. A settler will not invest years of labor when a company or official can later revise the claim. Large proprietary grants can reproduce European land concentration. Owners who hold more land than they can improve may wait for settlement to raise its value. Smaller grants and active occupation spread cultivation more rapidly. The design of land law therefore affects both equality and output. Trade restrictions operate like a tax on both sides of colonial exchange. Colonists receive less for tobacco, sugar, timber, or grain when they must sell through metropolitan merchants. They pay more for tools and manufactures when foreign suppliers are excluded. The difference supports monopoly profit and shipping interests. The mother country may still observe rising exports and call the arrangement successful. But colonial growth can be strong enough to overcome the burden. The fact that a restricted trade expands does not show that restriction caused the expansion. Smith repeatedly warns against attributing natural growth to the policy that taxes it. Smuggling reveals the gap between legal routes and economic advantage. Colonists trade illegally when the price difference exceeds risk and enforcement cost. Extensive smuggling is evidence that regulation conflicts with demand. It also corrupts officials and teaches citizens to treat law as an obstacle. Plantation slavery creates another apparent advantage built on hidden cost. The owner does not pay a free wage, but must purchase, supervise, and replace coerced laborers. Work is performed under fear rather than interest. Carelessness, resistance, and the expense of control reduce productivity. Smith observes that people often prefer commanding slaves to employing free workers, even when slavery is less profitable. The preference comes from pride and the pleasure of domination, Economic interest is therefore not always strong enough to overcome social power. The crop and settlement pattern influences labor institutions. Large-scale sugar and tobacco estates support concentrated ownership and coercion. Small farms producing grain and livestock support more independent households. Political institutions then develop differently from these economic foundations. Representative assemblies in British colonies limited governors and controlled local taxation. The assemblies served settler interests rather than universal liberty, but they accustomed colonists to consent and fiscal autonomy. Metropolitan claims later collided with institutions that had already exercised power for generations. Smith's proposal for representation in an imperial parliament is an attempt to reconcile taxation and consent. If colonists contribute to general expenses, they should receive influence over those expenses. Representation would also force Britain to treat colonial interests as part of the same political calculation, rather than as objects of regulation. The arithmetic of representation makes the proposal radical. Fast-growing colonial populations would eventually command a large share of seats. The center of political power might move across the Atlantic. Smith understands that British politicians who speak of imperial unity may not accept its equalizing consequences. Peaceful separation, therefore, appears economically rational. Trade does not require sovereignty. Britain buys from independent European countries and can buy from independent American states. Cultural ties, common language, and mutual interests could preserve commerce after political control ends. The cost of empire is often justified by the market it allegedly secures. Smith reverses the question. If the market must be secured by war, fleets, garrisons, subsidies, and monopoly, the net gain may be negative. Merchants receive the market, while taxpayers finance the security. National glory complicates the calculation. Citizens can identify dominion with greatness even when they receive no direct economic return. Ministers gain prestige from territory, and military institutions gain employment. Empire persists through political rewards, not captured in commercial accounts. The East India Company represents the most dangerous form, because the merchant becomes sovereign. A company seeking dividends can raise revenue and restrict trade simultaneously. Its servants may profit privately from offices, contracts, and local monopolies. Shareholders far away cannot monitor either administration or abuse. A normal government, at least, has a long-term interest in the taxable prosperity of subjects. A trading company may prefer immediate commercial gain, even if it impoverishes the territory. The conflict between ruler and monopolist is built into the institution. Smith's condemnation of European conduct in America and Asia is therefore connected to his economic theory. Violence and monopoly are not external moral accidents. They arise when political power is used to secure private commercial advantage and when distant peoples lack representation or legal protection. The conclusion of Book 4 also clarifies Smith's relation to the physiocrats. He agrees with their insistence that the economy is a circular process of annual reproduction. Advances must be replaced, classes exchange outputs, and taxes ultimately come from the revenues created by production. He also shares their opposition to detailed mercantile control. Free movement of grain, secure property, and a reduction of monopoly are central to both systems. The physiocrats helped redirect attention from the treasury stock of metal to the recurring flow of produce. Their error is to identify the net product of agriculture with all new value. Nature contributes to crops, but human labor and capital transform materials into goods worth more than the inputs consumed. The absence of land rent in manufacturing does not make manufacturing sterile. A loom, forge, or workshop reproduces the materials and maintenance advance to workers and adds profit. That output can maintain additional labor in the next period. It therefore fits Smith's definition of productive labor, even if the surplus takes the form of profit rather than rent. The physiocratic class structure nevertheless provides a useful analytical simplification. Cultivators, proprietors, and artisans receive and spend revenue in recurring patterns. Smith retains the idea of classes defined by revenue sources, while replacing the sterile class claim with wages, profit, and rent as joint components of value. The single tax on rent attracts Smith because rent is visible and land cannot flee. Yet actual incidence is more complicated. A gross tax on produce can discourage improvement, while a tax on net rent requires valuation. Taxes on consumption and transactions may reach different revenues with different costs. Natural liberty emerges from the comparison of systems. Mercantilism gives privileges to towns and trade, physiocracy gives theoretical privilege to agriculture. Smith's alternative does not assign government the task of choosing the productive class. It allows capital to move according to return under justice. This freedom is compatible with defense-based restrictions, public works, and basic education. The point is not that markets solve every collective problem. It is that ordinary allocation is too detailed and changeable for central direction, while monopoly gives officials and private interests incentives to misuse power. Book 4 therefore transforms the earlier analysis into a theory of policy. A regulation should be traced through prices, capital movement, profit, wages, rent, taxation, enforcement, and political influence. The immediate expansion of a favored industry is only one part of the account. The book's repeated standard is the annual produce available for consumption and future production. Bullion, exports, colonies, and subsidies matter only through their effect on that real flow. This standard prevents the state from declaring success merely because selected merchants become rich, or customs records show a surplus. The system of natural liberty is also a presumption, rather than a mechanical rule. The burden of proof falls on those who restrict entry, trade, or movement. They must show a public purpose that cannot be achieved through ordinary competition, not merely a benefit to an existing producer. Smith's historical examples show why this burden is necessary. Privileges begin as responses to war, revenue needs, or early development, and then become property-like claims. Interested groups organize around them, making repeal politically difficult. Prevention is easier than reform. By the end of Book 4, political economy has been redefined. Its object is not to enrich the sovereign with money or to guarantee merchants a favorable balance. It is to provide abundant revenue or subsistence for the people and enough public revenue to perform the legitimate duties of the state. Book 5 turns directly to those duties and revenues.